I'm Nimit Brahmbhatt and welcome to my Not So Profound Thoughts. So, today in this video, I'll be talking about the resilient India and which stocks to invest in. In the previous video, I talked about the whole concept of the resilient India and what is happening in the current scenario and how the India can earn or we can earn by investing in the stocks. So, welcome to this session of the resilient India and stocks to invest in. So, about the resilient India stocks that I have selected in this portfolio that I have made, considering only 20 stocks and even less than 20 stocks. So, the type of stocks that I have avoided is the group companies such as Reliance or Grasim or any parent company that is like Bajaj Finance. Why? Because majority of the companies have different allocation, capital allocation or the equity they have allocated into different companies, which may or may not give the return on capital employed that much as an individual company might give, and it might hamper the overall performance of the company. The second is the cyclicals, that is the automobile companies, because they are difficult to track according to the cycles, the stalwarts, and the pharma companies. The pharma companies, because I have a very less understanding of the pharma sector as in all, and because of the not availability of the knowledge, I have not included the pharma companies. The things that I have considered while making this portfolio is the financialization of the economy that I talked about in the previous session or the previous video, that we since the 2014 there has been an increase in the financialization of the economy, wherein the UPI as well as other modes of payment, that is the online and internal banking has been improved. Then comes the China plus one strategy, the strategy wherein people or the MNCs do not wish to rely just on China, but wish to invest in other countries so that the supply chain is not disrupted, as what has happened in COVID-19 scenario, wherein the lockdown that the China or the whole world had, and currently China is still facing with the COVID-19, and because of that, they are thinking of shifting their manufacturing sector not only in China but to other countries, wherein they can strategically allocate the capital and uh, make sure that even if there is another pandemic, the supply chain is not disrupted as much as it is now. Then the inflation in crude price and other worries that I have considered while making this portfolio. And I have included three types of stocks, that is the financial stocks, FMCG stocks, and technology based stocks, which are basically on the above three mentioned factors or the whole theme, that is the resilient India, and how these types of stocks have shown the resilience towards the pandemic and the recession that is going to come. So the important factors while I have considered, or the factors that I have made more weightage towards, is the revenue growth since the past 8 years, which is usually at 10% CAGR, or the companies have grown their revenues at a 10% compounding every year. The CFO growth, or you can say the cash flows from regular day-to-day operations, which has made a filter of growth of more than 10% CAGR. The free cash flow growth of 10% CAGR, as well as, I believe, the greater the cash flow, the higher the tenacity of the growth in future. So if the cash flow is 20%, the company might be able to grow at 20% also, or even the higher the cash flows or the free cash flows, the company has the ability to grow at that greater speed. The ROCE, that is the return on capital employed, and not ROE, because the companies might have taken loan and it is because of the total capital employed of more than 15%. I believe that what I have learned, and over a longer period of time, that it is the actual price returns or the price returns that the stock gives is basically a reflection of ROCE, that over a longer period of time it matches the ROCE of the company. So you can see the stocks that I have mentioned it. the resilient India stocks. I have not used average but used the median, because the average in case of cash flow from operations, ROCE, and the share price would distort because of the extreme values, as you can see in the companies that I have mentioned. If we look at TCS, Infosys, LTI, Tata Elxsi, all these are technology stocks. Why I have selected? Because you can see that the revenue is basically constantly above 10% CAGR. The cash flow is also about 10% CAGR. The free cash flow also about 10% CAGR, and a return on capital employed as compared to Nifty 50 is way more than what you can have as a average. So while the Nifty has given 6% median ROCE, my portfolio stocks, that is TCS, has given 54%, Infosys has given 34%, LTI 50%, and Tata Elxsi, that has given 52% over the past 8 years. So this is the ROCE is for the past 8 years in average, whereas the share price, which I have mentioned, has grown over the past 4 years, past 8 years, on a compounding basis that has been derived on a CAGR basis. So why I have included these companies? These companies I have included because, as I talked about the financialization and the current recession that is going on. So currently, if I look at our GDP, the service sector contribution, our service sector contribution is uh, 0.25 billion of the whole economy, that is the GDP contribution. And if we look at the US service sector contribution, it is 15.6 or 76 per trillion dollars of economy. So even if I take a conservative number of 10%, wherein if 10% of the contribution comes to India because of the current inflation and the supply chain shock and the great resignation that is going on. Why I believe this is because the current inflation in US is 9.1%. That is the latest number that has been presented over. And if we look at India, it is 7 or 7.1% inflation is going on. So even if they wish to close the gap, according to the Fed, the current rate of interest is 1 to 1.5%. And if they need to close the gap, there would be more difficult times in US, as well as they would have to shell out more money if they wish to employ their people in order to provide services for the basic necessities or basic services in the IT sector, as well as any other sector also. But if we look at India, the RBI does not need to increase that much, or we won't be impacted that much as US, because the rate at which we can close the gap is almost 2.5%, wherein the repo rate is 4.5 to 5% as of now, and the gap which we need to close is almost 7%. If we compare it with US, the gap they need to close is almost around 7 to 8%. So I believe that the TCS, Infosys, LTI, and Tata Elxsi would be the gainers in this. It's not that the other companies won't be earning. I have a target of 18% CAGR in the whole portfolio earnings, and I believe that these stocks would be going and giving me the returns. If I talk about the financials, you can see that I have included HDFC Bank, Kotak Mahindra, HDFC Life Insurance Companies, ICICI, Lombard General Insurance. So these are the company. HDFC Bank and Kotak Bank have given a revenue of 14% and 15% CAGR over a period of time, and have a profit after tax that has been compounded at 18% and 21% CAGR. If we talk about the return on equity over it, it is the 18% and 13%, and have over the past 8 years have given me a compounding of an average of 20% CAGR in share price. Even though many people believe that HDFC is not performing well in these days, but you can see the fact that over a longer period of time, HDFC and Kotak Mahindra has outperformed the market over a very huge number. Now, if we talk about life insurance, that is currently we have a market penetration of insurance in India that is around 3%, which was mentioned in the LIC prospectus also. And why I have selected HDFC Life Insurance as a company? Because it has been able to outperform in many areas which the LIC has not been able to, even though it has more market share in terms of the performance in bringing new business, that is new business premium, as well as the person employed and the premium that it brings. Has been performing better than the other peers, as well as the ICICI Lombard General Insurance Company. It is the same that even though the current Indian scenario is under penetration, as well as the companies or the whole sectors are going formalized, I believe that this general insurance company has overperformed, as well as I believe this ICICI is going to perform better than the peers, as well as in its track record, it has overperformed other peers. And you can see that it has given a revenue over the last 18 years, even though we had a pandemic, or even though we had major problems, it has been substantially growing at a pace of 18% CAGR in its revenue. You might be wondering why I have included Nestle. That is, if we talk about the FMCG sector, even though it has Nestle has 5% revenue CAGR, 4% CFO CAGR, 1% free cash flow, and 83% ROCE. So basic reason is because of the ROCE of 83%, which outmaneuvers every other peer that it has, as well as its monopoly in uh, the baby powder product, that it has 97% market stake or market share in India, and not any other competitor is not able to beat that. So basically, even though it is a mature company, I can say it is not growing substantially that much, but it is still growing, and the monopoly that it has in the baby products is not able to, is the basic moat that it has, and the other competitors are not able to compete with it. If I talk about the FMCG in oil, Adani Wilmar is the latest addition that I have included in it. And you already know Marico, that is Parachute, which holds a substantial market share in the hair oil as well as other products. And it has been adding distribution channels and complying with distribution channels, as well as you can see that it has a free cash flow growth of 21% and a return on capital employed of 35%. And it has a share price growth of 19% CAGR, which has been in the 8 years, compared to Nifty, that is around 11%. So this is about Marico. Adani Wilmar is in market, that is the oil market, wherein edible oil market, wherein it is like a furniture market, wherein there are small number of players in the market. But if you look at the Adani Wilmar market share, it still accounts for 8% of the market share, as well as in recent buy, it has bought Kohinoor brand, which is the largest in India in the rice product. So it is growing in that manner, and I have not included the share price growth of Adani Wilmar because it has not been at least a 1 year. But considering the other factors, Adani Wilmar has a revenue growth of 12% CAGR, and with an ROCE of 20%. If we talk about Page Industries, Page Industries is the jockey that we use. It has a great customer loyalty, as well as in the recent years, you can see that ROCE is 62% and has over the past 8 years given a 21% share price return. This is because it has constantly updated its technology and has bought in a new software which provides the demand forecasting and which analyzes, as well as because of that they need to keep a lower SKUs or lower inventories they need to manage, as well as they are opening their own stores or particular fixed jockey stores which you might see in your nearby area. In Pidilite has given a return on capital employed of 35% with a free cash flow of 17%, and cash flow from operations has grown with a 15% CAGR. Because Pidilite has marketed its Favicol, it has expanded to Favicol Marine and other adhesives, as well as it has invested and acquired few other companies such as Araldite, and has been consistently growing in that way. If we talk about Relaxo Footwear, uh, I have included Relaxo Footwear and not the other companies such as Bata and which are into premium segment. Why? Because it has advantage that the amount of free cash flows that it generates, it has the ability to open up a factory every year in every state. Why? Because the if we talk about our overall Indian consumers, if you look at Hawaii chappals, you can search it on Amazon. Relaxo has the least lowest price that you can buy and with a great quality of the rubber. So Relaxo has taken a lower segment of the market, that is what the 80% of the India represents, that is the middle class, and it has focused on uh, giving services to the middle class. If I talk about Asian Paints, and Asian Paints is a company that has over a consistent period of time has given 10% CAGR returns and has been a consistent performer over the past 8 years and even before that. Why it has been able to do this is because Asian Paints was earlier into it. Asian Paints still has a market share of 51 to 55% in the paint industry, as well as it has a specialty paints in certain industry. Plus, it has started into vertical integration. That is, it has started acquiring home decor and other services, wherein they are growing constantly, and the revenue from home decor and other services has been growing constantly. So if I compare it with Nifty 50, so since 2000, the first that is being shown is 2014 to 21, that is the 8 years. So if you had invested rupees 10,000 every year, considering equal weightage that I have given in the portfolio, you would have earned 2.07 lakhs, that is with 21% CAGR compounding, as against 1.31 lakhs if you had invested in Nifty. So even the past historical records show that my Resilient India portfolio has performed better than the previous. So if we look at the revenue comparison over the Nifty and the portfolio that I have created, you can see that in every segment, that is revenue, cash flow from operations, ROCE, and share price, there is a huge difference that my portfolio is showcasing. The free cash flow that it is not showcasing that much huge difference is because of the product or the companies that are there in Nifty 50, and the companies such as Reliance and all, which has a huge free cash flow, and that is why the average of free cash flow is going up in Nifty 50 rather than my portfolio. But still, if we look at comparison, so there is 19% and 26%, which is not that huge in free cash flow medium. So if you look at the previous year problem, so you can see that my companies, if you make it in a small case or you develop these companies and ask your brokers to track these companies and you develop a portfolio in a small case app, you would find that in the previous year my companies have not performed as good as the Nifty 50 that has performed. The major reason being that over the last 2 3 years, the stocks which have performed are into different sectors, and my companies, even though they have over a longer period of time uh, shown resilience towards the downfall, it has not been able to perform that much. Why? Because the previous year problem, if I talk about, if we look at the composition of Nifty 50, top five companies take up 57% of the net profit, as well as the weightage they have drags the whole Nifty accordingly. So even if there are losers in Nifty, majority of the companies such as JSW Steel, Infosys, Reliance, Bajaj Finance, and all take up the maximum weightage and moves the Nifty according to it. So if I talk about the sales variation of the previous year, you can see the resilient India portfolio has shown a sales variation wherein the median sales variation, wherein the Asian Paints, Bajaj Finance, GMM Pfaudler, HDFC Bank, life insurance, both the life insurance companies, Infosys, Kotak Mahindra, LTI, Marico, Nestle, TCS, Elxsi, and even Titan company has shown greater sales variation, wherein they have grown with a median or an average 10% CAGR, wherein only three companies such as Pidilite, Relaxo, and V-Mart have reduced their sales because of the constraints of the COVID-19, as well as the impact of the crude oil and inflation that is taking place. If we if you look at the composition of Nifty 50 sales variation, the Nifty 50 has been up, but as I talked about, the top five companies take 57% of the profits that the Nifty 50 has. You can see that the companies which I have not invested or not allocated my portfolio are basically the Coal India, Tata Steel, UPL, ONGC, Reliance Industry, JSW Steel. So if you look at the current scenario, that is the oil prices are going up, which has ONGC and Reliance Industries going up, as well as JSW, Tata Steel, UPL are all commodity industries wherein the metal prices are also increased because of substantial challenge of supply chain. As well as if you look at Coal India, you already know that there is coal shortage going on, and thus the prices have increased substantially, and Coal India has performed better. So these are the types of company which I would not like to have in my portfolio. The reason being that they are not consistent, wherein the prices of the steel is not based on the manufacturing capacity that the company has or it provides, but it is because of the price of commodity, wherein they can earn better revenue or they can even make losses. I have even avoided the telecom sector because if you look at over a period of time, the telecom industry has not been able to generate substantial return on capital employed over the investment or the capital allocation they have done. So that's it. The fund that I have created is with a goal of 18% compounding with the previously mentioned points, which are given the maximum weightage, the points that have been given maximum weightage, and I have not included more than 20 companies, which makes it almost like investing in a mutual fund. So even if you believe that I have excluded few companies and you have a better understanding of pharma companies such as or the chemical sectors will grow in future, so you can include them in your portfolio in according to the portfolio I have made, or even exclude some of the companies which you don't feel that my explanation is not valid for some companies, and you can exclude those companies and create a portfolio of your own. So this is what the Resilient India portfolio is, and that's all for today. Thank you.